Let's jump into the bond market as things are looking a little bit bleak for bonds. A little bit, gosh, very bleak. So, what are you seeing on your end, and how serious is this credit crunch?
I think it's sort of a stealth crunch right now in terms of earlier we talked about nobody's really been taken out yet, but I think that is yet to happen. It's very serious. The volatility is intense, and underlying the volatility, the trend is going to continue to be for higher rates, which is going to impact credit portfolios, credit funds, pensions, et cetera, et cetera. So there's nothing around the corner that's going to stem the volatility or the hits that portfolios are taking. It's pretty much going to get a lot worse, I think, before it gets better.
You've been saying that you've been in cash. I'm in cash. So, are you looking for a bottom to start anytime soon to start buying, or are you expecting more pain?
The caveat to being in cash, there's still trading opportunities, mostly from the downside. So we're certainly taking advantage of those. But as far as long holds, no, there's nothing really. I'm starting to look now. I've got a long list of companies that we're going to buy, we're going to leg into and average down because I think the market has lower to go. But you never know where the bottom is. I don't think we can pick a bottom this time. The thing that I would look for some kind of bottom is for the Fed to stop raising rates until we have some clarity as to their hiking policy prescription is either not working and things are breaking and they're going to have to pivot, or inflation comes down significantly enough where we can see that the pivot is going to happen, and then before it happens, we're going to see the markets base out, and then if you can catch that bottom when it comes, that would be remarkable. But right now, there's too much risk trying to pick a bottom here.
So, what area of the market in particular are you keeping an eye on with your members of Hyperdrive portfolio?
Well, first and foremost, the zombie stocks. I mean, there's so many zombie companies out there. Really started following them intensely in 2018 when the Bank for International Settlements came out with this incredible report about how dangerous zombie companies were globally and how many there were and what was happening, what the likely event would be if some of them or a lot of them broke down and couldn't pay back their debt, et cetera, et cetera. So really started amassing lists and keeping an eye, and rates went up a little bit, then they came back down. So these companies have, survived longer. Well, they're at a point now where there's no turning back. A lot of them are going to go under. Some of them are going to maybe be saved. That's their only hope, is to be saved by some white knight or something. Other than that, that's really a hot area for us to be making money on the downside. We've got a bunch of trades on. We're going to put another one on today. We're going to drop one today at noon. And I think I'm looking at the market and I see we're up a little bit this morning. If we continue to bounce a little bit off of last week's lows, I think then we're going to see a busy week for us in terms of putting on positions, because these are dead cat bounces. We're also banks. I think we're going to be keeping a hard eye on banks coming up in the earnings reporting period to see what's the state of the economy, what are the state of their loan books, what's the state of the consumer, and mortgage backs. It's a big issue for us. We're going to drill down into MBS.
So MBS, that's critical. The Federal Reserve owns about $2.7 trillion of mortgage-backed securities. Effectively, Powell signaled that they're not going to be selling any of these back into the market. So what is it about MBS that makes them stand out right now? Is this a housing play for you?
Well, in particular with mortgage-backed securities, and a lot of folks don't think about this, but so it's a brief lesson in duration. With mortgage-backed securities, there's a particular duration to a portfolio based on the mortgages are going to be paid off. When interest rates decline, people refinance. They pay off those mortgages and they take out another mortgage at a lower rate. So those portfolios that have those, their duration is less. When interest rates go up, the duration of a mortgage-backed securities portfolio lengthens. And we know what happens as interest rates rise. It's the longer end of the curve that gets hit harder than the shorter end. So this is a double whammy for mortgage-backed securities portfolios. And I think it's an opportunity for us and everybody really to take a look at where you can make money. The quick, fast, short, easy way would be looking at housing stocks that have already been beaten up. D.R. Horton, Lennar, there's opportunities there. There are opportunities in taking maybe short positions, some of the realtors like Redfin. But there are also mortgage-backed securities ETFs that folks can target and buy puts. We prefer put spreads for the most part. And there's a couple of great ones. The biggest one is MBB, and that's an almost $92 billion portfolio. That's the iShares MBS ETF. The other big one is not nearly as big as that's the SPMB, and that's the Spider mortgage-backed security. So there's opportunities there in buying put spreads, both of those, but MBB in particular.
One more time, can you repeat the tickers?
Yeah, MBB, that's the iShares. That's the large one. That's the one that I prefer because there's more liquidity there. Volume is a heck of a lot more. So that's MBB. That's the iShares MBS ETF. The other one is SPMB, much smaller fund, but decent volume in that. And that's the Spider mortgage-backed securities ETF.
You also mentioned that you were looking at some of the banks. Are there certain banks that you're looking at? Are you looking at names, or are you looking more in the kind of the regional territory, depending on the exposure that they have to the housing market?
We're not making an immediate move. Really want to see how the earnings turn out. I want to hear what the forward guidance is. I want to see what loan books like. I want to see what kind of reserves are being set aside. Banks have done very well. The stocks have come down a bit, but we had a tremendous run on the way up. I made an awful lot of money on the way up in financials, starting buying them in the summer of 2020, because they were releasing reserves and that adding to their earnings. And then now they're doing the opposite. They're going to start to reserve more against potential loans. And I want to see the numbers there relative to their loan book size. And there's a lot of stuff that's going to come out in this earnings season for banks. It's going to be very telling as to where consumers are, where banks are in terms of the future trends. And it's not just about net interest margin. Everyone thinks, when interest rates rise, banks' net interest margin increases. That's just one small piece. So we're keying in on financials this earnings season.
So this is all very important. Let's break this down a little bit for people because, again, from 2020, you had the Federal Reserve effectively dropping a lot of money from the sky, providing liquidity to the banks. Now that process is reversing. So when you talk about reserves, when you talk a little bit about how interest rates may impact these companies, what specifically are you looking for in terms of fundamentals? Because as we've said, fundamentals haven't really mattered for 13 years. They matter now. So what are you specifically looking for within those banks?
Banks and the zombie companies are looking at essentially the balance sheets and how much leverage they're carrying, and where, in terms of the zombie companies, how expensive is it going to be to roll over their debt? And it's going to get increasingly expensive. The banks are going to have problems because consumers are going to get tight eventually, and they're going to have a hard time paying off of their credit cards and their loans, and if interest rates continue to rise. MBS issue with short-term loans, people are taking short-term. Rates come down, we can refinance. It's going the wrong way for them. So there's a lot of the nuanced numbers and metrics within the earnings that are going to be very telling. And hopefully you'll have me on here and we can go over a lot of that stuff, because don't need to set up a trade beforehand. There'll be plenty of time when we see the earnings to put on great positions.